Hello, everyone, and thank you for joining us for this Gold Investing 101 session hosted by the Six. I'm Stephen Soock. I'm an equity research analyst with Stifel GMP based out of Toronto. I cover the junior gold and silver space, junior producers, developers, a number of exploration companies. I've been on the Bay Street side of the business for about 6 years, and before that was a mining engineer at various operations across Canada. With me today is Patrick Donnelly with E79 Resources, Brian Skanderbeg with GFG Resources, David D'Onofrio with White Gold. Thank you so much, gentlemen, for joining me today. I'll pass it around the table to start off with to let each of you introduce yourselves and your companies in a little more detail. David, let's start with you.
For sure. Thanks, Stephen. Great to be here. Thanks for the invitation. I'm the CEO of White Gold Corp. White Gold Corp is a Canadian-based exploration company. Our projects are in the Yukon, Canada, in what's known as the Klondike or the Dawson district. So we have a very, very large land package of 350,000 hectares, and it starts from Dawson and goes about 100 kilometers south to the Coffee deposit, which is currently being developed or put along the development process by Newmont. Western Copper and Gold's massive porphyry is right there as well. This is the area that was made infamous 125 years ago with the Klondike gold rush. And since that time, they found 20 million ounces of gold at surface. But remarkably, no real modern exploration was done until about 15 years ago. This was a new initiative that Sean Ryan, a great prospecting visionary, developed, and we went there to sort of try and figure out why it was that people weren't prospecting. And his findings were that just this area, believe it or not, was not glaciated. So the typical prospecting tools used in many parts of the world just weren't effective there. And I guess people kind of overlooked it, notwithstanding this prolific gold placer history, which is continuing to this day. All these great shows on A&E and whatever else. And remarkably, within a couple of years of him starting to try to identify how to find mineral systems, working with other companies to test that, there was two major gold discoveries that were made. Probably talk about a lot of this later, and what led to that type of investment and why people were interested in doing that. And the first one was by a company named Inferred Resources. They developed the Golden Saddle deposit that was acquired by Kinross for $140 million. White Gold actually is now the owner of that asset, and we've continued to do some work on that and shown it has a tremendous amount of upside. And the other big discovery there was made by Kaminak Resources. This was the Coffee deposit, which is now owned by Newmont. That was sold initially to Gold Corp for $500 million, and now is owned by Newmont after Newmont having bought Gold Corp. So we have a very interesting company in that we have this Golden Saddle asset, which we've developed up to about 1.8 million ounces, all categories. We think there's a tremendous amount of upside there, which we're working to demonstrate. And we also have this very large grassroots exploration package that we've been working through the same protocol that Sean used to make his first discovery. And we kind of really feel in the last 10 years, he's cracked the code. And we've made a number of very significant new discoveries to date, which we are following up with, in addition to this really significant pipeline of earlier stage properties, which we're going to work through the same protocol. So a lot going on to have in one company, but from management perspective, we really feel we're fortunate to be able to have good, tangible, high grade ounce deposit, as well as this very exciting upside. And we think that our excitement and has been validated by the fact that we've been able to attract two major mining companies as our partners, being Agnico Eagle and Kinross, who are major shareholders of our company, along with management, Sean Ryan, the Power One Group, and some other very notable sophisticated investors in this industry.
Perfect. Thanks. Over to you, Brian, next.
Yeah, thank you very much for the introduction, Stephen, and very good to be with yourselves today. I'm the CEO of GFG Resources, Brian Skanderbeg. We founded this company back about 6 years ago, and GFG, for anybody that's wondering, is go for gold or gift from God, and depending on which way you want to throw that. But we're district scale explorers. We're very much focused on the Abitibi and the Timmins area, where we've amassed a very large land position in 3 large blocks over the last 4 years in a series of transactions. We also control a large district scale gold play down in the US, where we partnered that into a company called Group 11 Technologies. So at a high level, GFGs is a district scale explorer. We have a couple advanced projects in the Timmins area. One of those chiefly called the Montclair project, where we're actively drilling it now, advancing it towards resource and a large associated land position with it. This would be east of Timmins. We also have 2 large blocks west of Timmins, a little earlier stage. One of those would be called Penn and one would be called Dore. So combined, they're almost 800 square kilometers, and we're second only to Newmont in terms of land tenement holdings in the Timmins Belt, and that's where we allocate our capital. Down in the U.S., unique partnership with, as I said, Group 11. These guys are trying to bring in-situ mining to the gold space, and I think there's a unique angle to be played there. GFG's contributed the asset to this group. They've contributed the technology, and we are owners of them as a private company. And I think they're positioning themselves to what could be a very large value unlock in the space and could be quite disruptive to the gold mining space as well. So GFG is a unique 20 million market cap explorer, 3 or 4 irons in the fire, very seasoned management. Our team ran previously a company called Gold Resources, and that was a producer here in Saskatchewan, which is where we're based. And we sold that into SSR Mining back in the 2015, 2016 timeframe. So I think seasoned group, very successful in the mining and discovery space, and focused our capital in the Timmins area. That'd be a summary. Thank you.
Great. Thanks a lot, Brian. And last but certainly not least, Patrick, do you want to tell us a bit about E79?
Thank you, Stephen. Thank you for having me on. Yes, my name is Pat Dolly. I'm a geologist and did that for a long time. And then, like yourself, Stephen, I was also on Bay Street for 6 years, covering mostly base metals. I'm in the corporate side now for about 10 years since I moved back to Vancouver, which is my hometown. And I only joined E79 last May. And what I found really intriguing about E79, it's early stage, which is what I really enjoy. And we're in the state of Victoria in Australia, specifically the Victorian Goldfields, which hosts the world-class Fosterville mine. And this is an area that's been relatively overlooked compared to other gold mining districts globally and in Australia. And I think what happened was there was a huge discovery at Fosterville, at the Swan Zone, where they discovered, at the time, it was Kirkland Lake, which discovered the Swan Zone, which had over 3 million ounces of gold, running at over an ounce per ton. And so that kind of opened everything up in the state of Victoria. There are a lot of players in there. We got this company off the ground in 2020. And on our third hole in 2021, we drilled 11 meters of 160 grams at our Myrtleford project. And Myrtleford's over 40 kilometers long, and it has numerous prospects, showings, adits, workings, what have you. What's really interesting about Myrtleford, it's yielded over 5 million ounces of alluvial gold. And so very similar to the White Gold District in the Yukon, there was a lot of activity in the late 1800s, and yet there's very little modern systemic exploration activity. And so when you look at the property, there are numerous showings of visible gold, coarse gold. So again, we're well financed, $6 million. Our market cap's $10 million. And we're in a very stable, safe jurisdiction in the state of Victoria. So leave it at that.
Great. Thank you all. So with that, just a little bit of housekeeping. This session is being recorded and will be available on the SIX website in the coming days, if not later today. If you have any questions, please submit them using the chat function on the platform, and I'll review them and pass them along to our panelists. So I'm going to start today with a question of my own, kind of addressing the big picture strategy. The overarching goal of exploration is obviously to find a future mine. This happening depends on a variety of factors, including the scale, grade, location, access to infrastructure, what have you, of the deposit, as well as the risk profile of where you operate and the ability to execute that plan going forward. How do you balance these variety of factors when you're determining the best places to start looking for projects? We'll go in reverse order here and start with you, Patrick.
Well, obviously, grade is king, right? So, if you're in an area that's got good infrastructure and and the cost environment's reasonable and the exchange rate's reasonable, and you don't have any metallurgical challenges, then you get away with a low grade. But if you're in an area that has challenging infrastructure, metallurgical issues, for example, refractory ore, or you have a high strip ratio, or you're deep underground, then you need grade. And so it's interesting when I do a quick and dirty evaluation of projects, I always calculate the NSR per ton of production and use a number of assumptions. And then when you get that, then you can start thinking about, okay, what kind of environment would this NSR per ton be applicable to, right? So, would it be applicable to narrow vein mining? Would it be applicable to bulk tonnage mining, such as block caving? And so it always gives me, when I do NSR per ton, it gives me a good idea of what kind of mining scenario or operation that we're looking at.
Yeah, it makes sense. Grade does go a long way. There's no debating that. Brian, do you want to have anything to add in terms of what's more important to you? And that's the factor. And I recognize too, all three of your companies have the benefit of being in relatively stable jurisdictions. So there's a degree of jurisdictional risk that kind of comes out of that. Nevertheless, everyone's evaluating projects all the time. So you've always got to be thinking about the mix of these factors.
Yeah, I have a little different view. I'd probably step to a little higher level and just start with endowment. And, when I look around the landscape, and you can define endowment a variety of ways, but I just look at, millions of ounces. So I look at Timmins as a belt and say there's 140 million ounces there. And then I look at what's preserved. And by that, I mean what's yet to be found, and try to give myself a ranking of that as a filter. So are we working in an extensive area to cover? How much historic mining has been done? Are we looking sub 500 meters for the next ore body? Are we looking in the first 100 meters? So preserved endowment is really where I start. And then I look at the systems, ounce per vertical meter. And, not unlike Patrick, you get to grade is king. And if you can get to NSR per ton, a different way to think about that, ounce per vertical meter goes to a really strong economic filter. And if you can get that number relatively early and put it on your graph of comparative deposits, it gives you an idea where you're headed. And so that's really where I head, is getting to preserved endowment, ounce per vertical meter, and then thinking about what is critical mass. And critical mass is very different in each belt. So if there's infrastructure, like there is in Timmins or like there is in various belts around here, a filter might be greater than 1 million ounces becomes an economic deposit. Whereas if we're dealing with Ring of Fire, or we're dealing with somewhere in way off the end of Northern Ontario, you need 3, 4, 5, 6 million ounces to start reading critical mass. So this concept of infrastructure is very key in our filter. Hence the reason to go to Timmins, where we have 4 mills within 25 kilometers. So I kind of take this filter and look around and say, preserved endowment, infrastructure, ounce per vertical meter, and then cost of entry, right? So this is the last piece. Is it even achievable to get into a camp like Val-d'Or? Very, very difficult. Cost is high. And so when I look at our filters across the Abitibi, across Canada, the GFG looked at lots of these. And we ended up where we did, as we felt it was the highest area of preserved endowment with the lowest economic threshold. And that's driven by presence of infrastructure and natural buyers. So that talks a bit about our strategy and why we go where we go.
It makes a lot of sense. And David, I imagine the concept of preserved endowment is a key important one for the White Gold story. Do you want to tell us how you kind of see that and why that's so unique to where White Gold's exploring?
Yeah, for sure. I think these guys touched on a lot of the great points. And in terms of preserved endowment, when you're in I would call it a new sort of emerging gold camp, it's a bit of the opposite. We think we're at the very beginning. In the White Gold District, the discoveries now are being made literally at surface. Maybe you've seen the video. Sean's there with his tulip auger, finding the gold and the mineralization in the system. So it's really all there. Now, the flip side of that is there's less infrastructure than in a more developed camp. What I like though about the White Gold District now is it's kind of a bit of a balance where the camp is starting to evolve. The majors have moved in. Newmont's there. They've done a tremendous amount of work this year. They're advancing that project towards production. So hopefully, we as a junior will be the benefactor of this significant infrastructure development that other people are doing. And, in terms of, checking the box, I like to look at it as checking the box when we're evaluating project opportunities. So, these guys touched on a couple of great ones. But sometimes, if just to sort of maybe distill this for how, our viewership here can look at things, there's an old expression: the best place to find a mine is near an existing mine. And a lot of the times what that means that all those boxes have been checked. This thing was economic, it was there, and it probably has the infrastructure, that the template for the permitting is there, the relationships with local communities, First Nations, Indigenous people is there. So a lot of that fabric, and certainly in these areas that we're talking about, a lot of that's been done, and I think that's really an important thing. When you have major mining companies making investments in different districts, major mining companies, they're almost like countries now. They're so big, and the threshold that the capital markets hold them to is so high. So these guys have to make sure that they've done all the right things, and so they've done the homework, and now they've gone through their checklist, which they have the benefit of staff of hundreds of people looking through all this. So if it can make it through their process and they're willing to make an investment in an area, I think that for investors and junior mining companies or people that are looking for new areas, that's a really, really great sign. And for our personal experience, like I mentioned, we have Newmont there, Western Copper and Gold is there, Rio Tinto put a major investment into them last year. Obviously, our partners, Agnico and Kinross, are there. So these are something I think people can look to as further validation of prospectivities of these different areas. And of course, jurisdictional risk, I think, is always been important this day and age. That's been identified and highlighted even more so, especially with public companies. You have to make sure that everything's being done totally to the law of the code of the different countries and exchanges and whatever else. So that that gives us additional security into that things are being done properly. But yeah, this endowment concept you touched on, I think that's critically important, right? I think as junior miners, we all are thinking big. We're looking for major successes. I think that's what our investors want to see. So they want to see that you have an opportunity to make a very significant multi-million ounce type discovery that's going to turn the needle, for the market, for majors, et cetera. As opposed to maybe just looking for rinky-dinky little things, that may not sort of garner that type of attention. I think this group here, that's what everyone seems to be doing.
Certainly, the size of the prize is an important consideration, but good point about having that external validation as well, and neighbors that can help provide infrastructure in some of these slightly more remote places. So kind of moving along the discovery process. Everyone on this panel has more than one target on their in their portfolio. How do you think about allocating time and money to a more predictable flagship target deposit versus building out that pipeline? And kind of to follow up on that, how do you gauge when enough work has been done on these earlier stage targets in the background to present it to the market and/or take that big swing for a big discovery hole or a big push through a field season? So again, maybe we'll just go in reciprocating order here. So David, we'll start with you.
Yeah, that's a great question. And, different investors, I think, look to different companies to do different things. And so part of it is how are you presenting yourself to the market? White Gold Corp, we look at ourselves as a project generator, right? We want to be there. We want to, make these discoveries. I think that historically has shown to be the best opportunity for significant value creation in a junior company. There's this concept of the Lassonde curve. Six actually just recently has done a panel on that, but for people that weren't there, it outlines the value creation of a junior mining company, and it starts off sort of very low when you're in your concept and thesis phase. Once you have that initial validation of your thesis, you make the discovery. Valuations will shoot way up. At that point in time, it's sort of uncapped value creation opportunities, right? As you do the more work, as you sort of put your resources on, you start to bring some constraints around. I think that might be something we're going to talk about in a bit. And then to the extent that's validated, now you're in project permitting, financing, et cetera. It gets a little bit quiet, and sometimes the market, maybe wants to something with a little bit sooner gratification, or at least maybe more so the retail community. That's kind of when the institutions step in that have different investment parameters. So from our perspective, I think we look to be able to optimize the value of the company. You can look to sort of the skill set of the people involved. Different companies are built for different reasons. Our team is all explorationists, and we look to sort of divest at the time where we think there's peak value for the shareholders, right? And that's why all of these companies are in existence to create value for shareholders. And, we'd ideally be looking to be doing that on that first leg of the Lassonde curve. We do have a project that does have a resource on it. That's a little bit unique in our situation, just because Kinross rolled that in after they made the acquisition of Underworld Resources. And so you might ask, why is a project generator taking in a project? The reason for that was actually our team that made that discovery. And Kinross, once we've had our discussion with them, they knew that these guys knew this deposit better than anyone on the planet, and the ability for them to show that there was incremental value that could be identified quickly and inexpensively, it would be sort of best in our hands. And we've been able to do that. When we acquired the asset, or Kinross merged it in, it was 1 million ounces. Now we're over 1.8 million. We're hoping to get it well over 2, very soon. And it really made sense. So we started with something, but we still felt there was that very immediate opportunity to create a lot of value.
Right. Okay. And actually, you touched on something there I want to pick up on, the milestone that is kind of a resource in the development of a deposit, a stated, third-party validated resource. Obviously, at a certain point, once you understand a deposit and start to get a critical mass there, that starts to be on the horizon. And while that provides a validation of the geologic model and the endowment, it's sometimes also seen as putting a pin in it. So how do you navigate achieving that milestone while still preserving the very real geologic upside across the rest of the pipeline? Maybe Patrick, I'll kick it over to you to speak to that.
Yeah, I mean, I like to think of myself also as kind of a observer of other companies, and I always see what other companies do and how the market reacts to them. And obviously that depends on what kind of environment you're in. And if you're putting out drill results that are good and the market's reacting, then you just keep working on that formula, right? And I've seen companies where they keep drilling and keep putting out splash results. And then eventually, I think the market starts to bake in that, there's going to be a resource there. And so, the question is, at one point, do you want to cut that off and come up with a resource? And I think, if you got the money and you're comfortable with, the continuity of mineralization and you see that continue on, then you keep drilling and you keep drilling as much as you want. And obviously, and you also internally, have some sort of basic estimate of what the resource is going to look like, right? So, and you got to balance that on your cash position and also the markets, right? So, it depends on the type of deposit you have. It depends on the markets, but I'm a big believer in just keeping the drill bit going. And if the results keep coming, then you just keep going down that road until it gets to the point where either you got the scale that you want in terms of ounces, or simply, you've drilled the deposit out. So I think that would be my answer. Okay.
You mentioned an interesting concept there of market expectations, in terms of a resource, because there's often momentum that comes behind continued high grade results or good success, which is great, but sometimes the market gets a little bit ahead of itself. So how do you think about managing those expectations while still having success and like I said, preserving that kind of upside and being able to daylight that? It's a bit of a balancing act, but how do you kind of square that circle in your head?
That's a great question. And it's funny, before I became a CEO, I was doing investor relations for quite a while. And I thought of my role as to manage expectations. And so, which is very, very, you got to be very careful because, you don't want to cause selective disclosure and also, put yourself in the spot. So, I think you got to talk to all your shareholders. You got to talk to, the markets, got to talk to the analysts, and you tell them this is the goal we're having. This is the goal that we would like. And so, and I never give an absolute number. I would give a range, right? So, we're looking at 500,000 to 1 million ounces. So you're kind of giving yourself a little bit of leverage, but at the same time, you're not setting yourself up for disappointment because, in the end, I heard someone say this. you're dealing with nature and mineral deposits. There's no mineral deposit that's alike, and especially if you're dealing with something that's nuggety, for example, Valley of the Kings or Pretium, that's a very challenging one as opposed to a porphyry. So I always give ranges. I make sure I'm out there talking to people, and I make and making sure that I'm consistent in my message as well. So I think that's how, again, you manage expectations when you're dealing with shareholders and investors.
Yeah, that communication is definitely a key ingredient to the whole infrastructure of the industry. Brian, do you have anything to add on kind of that balance between keeping the dream alive in terms of exploration upside and achieving those milestones and advancing and de-risking a deposit?
Yeah, look, I mean, I think it's different for every company too. We're generally explorers here, the three of us, but as you move up the pipeline, obviously a developer or a junior producer or material is going to have very different filters in terms of what they choose to disclose. I've always been a guy that believes you need to allocate capital where the best payback is. And to me, that's growing the resource, and that's your lower risk meterage. So if we can look at our budget of, say, $5 million and throw 75% of that into what we think is bona fide resource-based drilling. And we're not always going to have a target that's at that level, but that's the ideal situation because I think that's where the best value is. So if we look at budgeting within even somebody like GFT, we're taking 70 or 80% of our meters and we're putting it into something that I think is defining likely resources. And we're taking 20 to 30% of our meterage, and we're taking that and allocating it into the next phase of targets down further on the pipeline and saying, where's the next target that's going to grow to a resource or become something that's relevant? And I think that's an appropriate balance where you continue to move targets through your pipeline and you grow a resource, which is ultimately the anchor of your valuation. So I kind of really like that weighting, in terms of the decision to put out a resource. I think Patrick's point on, continue with what's working is a very good path, and Great Bear was a great example. Never had to put one out. Other companies have put one out and it was beneficial to them. So it's really dependent on market fundamentals, where the company is, what's working for you. And I would generally lean on the side of not putting a resource out until you really feel that it moves the needle in the market's context, or it moves the needles in a corporate's context. So there needs to be a really strong driver to put that out because, even as David talked about, this on curve valuation drop is often triggered by the resource being published or an economic analysis being published to it, and then the news flow changing. So it's a critical point in a company's journey of when they choose to do that, try to put the pin in. So I think you have to be very careful about why you're doing what you're doing. And it's very dependent on the dynamics of individual companies.
And I think the dynamic of the market is also a great backdrop to that, as you mentioned, that not all markets reward the same type of news flow. And depending on where we are in the cycle, that can be very different in terms of what you said you're getting rewarded for. That's actually a good segue into my next question here, that the gold market has obviously been quite difficult through the second half of this year. There's a balance to be struck between maintaining a defensive treasury position and being active in advancing your projects, especially from a de-risking your treasury perspective. It's either side of a coin. Can you give us some insight into what shapes these types of capital allocation decisions behind the scenes? How you think about how much and how fast you want to spend versus how much you want to keep for a potentially more rewarding market? And maybe Brian, I'll start with you.
Yeah, this is capital allocation 101, right? So do we really want to be aggressive or not? And, so much of this hinges on, yes, can we raise market? What moves the needle in the market? But in the end, we all have to stay relevant as a base case. And so if we looked at a budget of how much it takes GFG to be relevant in a year, it's $2, $3, $4 million in the ground. That's the minimal level that we feel it is in Timmins to be relevant. And so from my perspective, being irrelevant is not a choice. And so that's your base level. And then if you can raise more and you find that the market's there to support a program that is 5, 10 million, 10, 20 million, then why shouldn't you take that path? So to me, base level relevance at a minimum, then dictated by results, market fundamentals, being as aggressive as you can. And we all want to preserve value value meaning NAV per share, ounces per share, things of the sort. So, that's my general view of it, and how we operate with GFG is push to be as aggressive as we can and always maintaining relevance.
Yeah, we definitely have to stay active enough and keep that news flow. David, maybe I'll go over to you now. You have a bit of a different model with two kind of marquee seniors as key strategic investors. So, how does that change how capital is allocated or budgets are decided between both internally and I imagine also with the input of those key shareholders?
Yeah, we've been really fortunate to have a great relationship with our partners, and we keep a very open dialogue, and we actually we look to leverage their expertise to help us advance the value creation and maybe guide some of our decision making. That was actually a very big part of our decision-making process when we selected Agnico very early on to be our partner. When the company was put together in 2016, we acquired this incredibly large land package. It was right on the back of Gold Corp acquiring Kaminak. So there's a lot of interest. And we just felt that Agnico had such a strong technical team. They had experience working in Northern Canada. So they would be able to add that into our capabilities, in addition to sort of obviously the capital that they put forward. And one specific example I can get to that is we have this Golden Saddle deposit. It was a little bit over 1 million ounces at the time, and where do we sort of spend our time trying to grow it like we thought we had? And we did a little bit of drilling directly on the deposit once we acquired it. But then through these discussions, through their combined technical interpretations, we came to the conclusion that the best return on investment for us as a company, for the objectives that our partners want to have, which is to see continued significant resource growth, was to start looking for new zones of mineralization within a fairly close proximity to the core of the flagship deposit. And and I think the thinking is there's deposits are there, you pound away on them enough, usually they'll continue to grow, but what is the the incremental value you're creating there versus you find another zone of mineralization, you can establish a deposit there, assuming that is part of the same project. Those types of incremental, discoveries will be adding, 200,000, 500,000, 1 million ounces at a time, as opposed to sort of some just step out delineation. And that, we were really grateful to have that perspective, and it's actually worked out incredibly well. 2 years ago, we made a discovery just 2 kilometers to the west called Orion Surprise. And now, after working on it a couple of years, we think that's going to be highly accretive to the size of our deposit. Visually, it looks very similar to the type of mineralization. And it's also really opened up our eyes to a significant amount of blue sky opportunities in the area, as it sits on this big, 6-kilometer trend. It's 1 kilometer wide. That's seen a very limited amount of historic testing, which was really successful. But once the Golden Saddle was discovered, sort of all the attention went there. But now it's like, guys, don't forget about this. You've done a little bit of drilling, you've hit this new zone, it's really coming together well. You have all these new targets. Let's spend some time looking at that as well. So that's one example I have of how managing our perspective. I think that helps our partners see this thing has continued upside. We've moved to a scale that should be going to development, and it also shows our shareholders that this is a lot of blue sky opportunity on these projects as well. And back to my earlier point, the best place to make a discovery is near mine or near an existing deposit for all these other reasons we discussed earlier.
Yeah, it's certainly a lot of considerations and trying to bring all that together. Patrick, do you have anything to add on kind of capital allocation decisions, the way you see them within E79?
Yeah, and it's a great question. And I joined the company in May, and had my first board meeting in July. And when I got in front of the board, I came up with a 3, 6, 9, and 12-month budget and worked closely with my CFO. And I also came up with a 2-year budget. So, we're sitting with $6 million in cash. And so you got to be cognizant, what if there's no financing windows? And so basically, and I said to the board, this is what we want to spend to, up to December. And this is what we want to spend up to next June and so forth. And then here are the priorities we want to drill. So I think it's just having a plan in terms of what you're spending and understanding where your costs are, and then focusing that spending as Brian and David had stated on, what areas are going to get you the bang for the buck, right? Is it infill? Is it resource expansion? Is it exploration? And in our case, it was exploration and focusing on the areas of our project at Myrtleford that's going to get us bang for the buck.
Right, and kind of like David was saying as well, that incremental ounces are often the ones most rewarded in the market, those outside of kind of those expectations of around the edges of a deposit. So it's as explorers, certainly that's the business that you want to keep exploring, but with what sort of you said market expectations and access to capital considerations baked in as well. I'm going to switch tracks a little bit here and talk kind of about the current market dynamics. We've seen multiple valuation multiples compressed across the board in the gold space over the past two and a half years. But the magnitude of contraction in the exploration space has dramatically outpaced that of the producers, at least the ones that we cover here at Stifel anyway. So we have average, spot PNAVs of our Explorcos at about 0.17 times. So this is less than 1/3 of the relative valuation we saw at the peak in July 2020, and just under half of the 5-year average of about 0.4. So certainly depressed valuations, lots of opportunities. However, senior and intermediate producers sit at just 20% below their 5-year average spot PNAV at about 0.85 and 0.55 respectively. So a very large and widening valuation gap over the past 24 months or so. This seems like an obvious opportunity for accretive M&A for some of the bigger players, even if they do pay a substantial premium over the current market price for smaller companies. That being said, why do you think we haven't seen more of this kind of M&A through the current part of the cycle with, for the most part, majors and intermediate producers in a fairly strong paper and cash position and discount valuations at the smaller end of the space? Maybe Patrick, I'll start with you on this one.
Yeah, I don't think there's a single answer to that. Obviously, there's a lot of market headwinds right now, and there's a lot of worry what's going on there, what the Fed's going to do. Are we going to go into a major recession? And I think those factors come in. If you look at all the big players, some of them, they're dealing with their own problems, right? You look at IAMGOLD, they're dealing with problems at Cote Lake. You look at Kinross, they got their heads handed to them in Russia, and then they did this deal for Great Bear. So I think they're dealing with that right now. And I think also just right now it's just it's risk off right now for the majors, right? And we've seen in the past where they've done flurries of M&A deals. And then they've been punished, and so I think now they're a little bit more hesitant and they're a little bit more selective and disciplined, especially in an environment where we're entering some significant headwinds. So that'll be my belief why we haven't seen as much M&A. Hey, also it's still early, right? We've only it's only been a year or so since things got kind of crummy. If this continues on for another 1 or 2 years. Then they might start licking their chops. But right now, I think it's simply, they're just being disciplined because they haven't been disciplined in the past.
And that's certainly something the market has punished some of these larger transactions, especially the kind of bet the farm M&A style transactions over the past decade or two. So it makes sense that they're going to be a little more cautious. But they say the cheapest ounces are the ones that you find, but these sorts of valuations, there's a real argument to be made that they're not. They're the ones that you could acquire. So, I'm a little surprised that there's not more of this going on. So maybe, Brian, I'll go over to you if you've got any thoughts on, if this is something that's upcoming or why we might have not seen it just yet in any sort of major way.
Yeah, I think Patrick touched on some good points. I mean, I always go back and default. It's who has the mandate to act and the ability to act. So lots of groups may or may not have one or both of those. And in this type of market, you might ask yourselves, why aren't the producers acquiring more explorers or developers at present right now because of the PNAV gap that we see? The other way to think about this is also, as there is more consolidation in the space, everybody's filter grows. So Agnico 3 years ago would have had a filter that they may have looked at 100,000 ounce producer and fit it in their portfolio. Agnico today will not, have that in their mandate, right? So as the whole space grows, the B2s, the Kinrosses, and the size threshold of an individual organization grows. So the number of targets that are relevant size for them are smaller and smaller. And this goes back to the whole thesis of discovery efficiency, and discoveries of relevance are exceedingly rare. And they're becoming rarer because the size filters are becoming larger. And so this, I think, is a feedback where those with the cash have a good filter, and their filter is getting bigger. And that doesn't make their basket of producer or explorers any bigger. It makes it quite a bit smaller. There's not many Great Bears out there these days, right? So I think that's a theme that has came out of consolidation, and it's a very disciplined approach from those with the cash, the producers and the large-scale producers, as to why we may see this value disconnect. And then the flip side of it is that the whole risk-reward portion of the capital markets is really struggling for juniors. And so in many ways, we are facing liquidity challenges, investor appetite challenges, because people want something less risk. As Patrick said, it's risk off these days. And what that means is a preferential, or a disconnect between the juniors and the developers. We will certainly weigh on our prices and how we trade in this market versus the developers and the producers. And that's just what we're seeing. So I think it's understandable. And I think it's probably a theme that you'll continue to see play out. Good deposits that are sizable will get bought, no doubt about it. And we all need to reach that critical mass to be relevant.
Yeah, no, I definitely agree. Maybe just, David, lastly, have your thoughts. You said White Gold identifies as a project generator, so M&A or transactions are a core part of that sort of strategy and mandate. So how do you view trying to reach those meaningful thresholds for M&A or carve-outs or attracting kind of a takeover bid from a major?
Yeah, I think, as Brian mentioned, you want to be, and we touched on earlier, looking for projects of merit, right? And then, it's a great point. As the majors get bigger, their threshold is going higher. But at the same time, there are new entrants that are emerging. I think we see a lot of different groups from different parts of the world sort of start to hone in even more closely on Canada, just because of the jurisdictional issues that are going on other places in the world. These Australians, for example, especially with premium valuations compared to Canadians, I know that they're starting to emerge as interested parties. So it's, it's a little bit of, you have to, this is why I think another reason you have to keep yourself relevant. You have to continue to, show that you're building value, because, if and when, and it's not necessarily if, but it's when sort of things change, you want to be able to take advantage of those opportunities to optimize your value for the shareholders. And I think that, the lack of potential activity that's, will come out of these sort of, times where access to capital is more difficult is really going to only exacerbate an opportunity that investing in junior explorer codes, I think, is provided. The flip side is if things are depressed. The optimistic side is the opportunities for returns are more significant, and the world is not going to stop needing all these different commodities, gold and whatever else. And to the extent that exploration is diminished, when the time is that people need to be making acquisitions to increase their production pipelines, there's going to be less opportunity to go and make these acquisitions, which supply and demand, that'll lead to better valuations. So
that's a good point. The demand for ounces kind of at every level. And I think, Brian, you touched on this as well. There's almost this newly minted group of super major gold producers, right? With the kind of Nevada gold mine level, Agnico taking over Kirkland, the pending Yamana deal, those sorts of groups. So for every extra ounce they produce in a year, they've got to put one more or at least one more into their pipeline to be able to fill that production profile. So I agree that it's important to be able to be in the right position to maintain a position where you can execute on that. Following along that, when there is an offer on the table or you are there is a transaction to be had, the goal is obviously to maximize the shareholder value. So how do you decide when you've daylighted enough value out of your project, touched enough of the exploration prospects, versus when it's time to sell and kind of crystallize that value? How do you think about that balance between not leaving too much on the table from that exploration and being able to provide your shareholders with an attractive valuation in the current market context? Maybe Patrick, I'll start with you.
That's a really good question because, I've seen a number of companies that, they go through the discovery phase, they go through the resource definition, PEAs, feasibilities, and even into permitting. And as the market's not stupid. And, if you've got a project, you got a market cap of $100 million and your CapEx is $1 billion and, you're, and no one's biting, you're in a tough spot. And you can and even companies will start, hey, we're going to go permit it now. And yet there's no suitors coming around for the company. So it's a tough spot. And so all you can do really is to keep optimizing, maybe, de-risking the project or expanding the resource or the reserve. But in the end, it's really, it depends on the markets as well, right? If majors, are cash flowing and they generate a lot of free cash flow, then they're more amenable. Or if a case like, Pan American, they're doing that deal for Yamana because they've got a pipeline shortfall coming up and they need to continue ounces, right? But, like I said, it's not, I don't think a junior can dictate when they need to sell, right? They'll sell if they get the right price, but it depends on the environment. Sometimes you're a price maker and sometimes you're a price taker. And we've seen that before as well. So I think it's just, you gotta, you can't, let me just give you an example. I've been with other companies where, people ask you, what's your end game? And I'm like, oh, we're going to sell the company. And they ask, well, what if you can't sell it? Then what? And then, do you tell them that, oh, well, we're going to build it when, like I said, you got $1 billion CapEx, your market cap's $100 million, you're in a tough spot. So, and I think every company deals with that when they get to that point. And it's just about, trying to, again, put out news that moves the needle. And until then, you're almost playing cat and mouse with the majors.
Yeah, it's always a bit of a game that as a junior being acquired, you want as much value as possible, and of course, any potential acquirer wants to pay as little as possible and capture that value upside without paying for it. So, Brian, how do you kind of come at that thinking process around timing and how much value is in hand versus left in kind of the blue sky?
Yeah, look, it's something I have experience with Claude. We transacted with SSR and ran a process and sold our company into a mid-tier, and it was a very learning curve for myself in my career. I think there's two ways to look at this. What are we good at? What do we do? How do we compete as a company, right? So are we explorers? Are we developers? Are we mine builders? Are we mine operators? So where's our capacity in our organization at the executive, the management team, at the board level? And I think many of the failures you see in this space are when people try to do things they're not good at. And if you're an explorer, recognize you're an explorer. If you're a developer, Patrick Downey, my board chair, built lots of mines. He's a builder. If you're an operator, operate. And so to me, that's the overarching things, what you're good at. And then you have to look at, what can we do internally versus externally. So a good example of this was with Claude. We recognized we brought ourselves to a healthy position where we weren't playing defensively. We actually had enough strength and balance sheet. We had enough time in front of us. We had enough shareholder support to feel like things were firmly in our control. And then it was understanding the landscape. And understanding the suitors. And often, if you look hard externally, you can find a better value build externally than you can maybe internally. And that's a really good sign as an organization. If you can pair up with somebody that can outpace your value build and or complement it and de-risk it. So in our case, we just de-risked the organization. Single asset producer went into a basket of mid-tiers. We brought somebody in that can provide capital and develop the mine more quickly. And we received a premium, and we took that premium in paper, and their paper was exceptionally cheap. And via that, they could outpace us. So it's quite a complex decision, both viewing these things internally and externally. And it's very event specific or company specific in terms of go about it. But that's a bit of my experience.
No, that's an interesting perspective, having been through it before and actually had to have those discussions where the rubber meets the road, so to speak. David, I'll just kick it over to you. You know, again, just coming back to the model as a project generator, there's obviously lots of options where don't necessarily have to sell the whole company. You could carve out portions. You could keep a deposit. You could, come in with a partner. You know, how do you start to think about when certain parts of the portfolio are ready for those sorts of discussions, and who to start calling when they are?
Yeah, I think, at the end of the day, it's all going to boil down to risk versus reward, right? Where can you build the most values for your shareholders? Obviously, a lot of variables outside of everyone's control, and part of this process can be as much of an art as it is a science. But you want to be able to look for opportunities where you're making good use of the capital, and you're doing stuff that will be value accretive. And I think just part of the way to ensure that that's being done is looking for situations where there's close alignment between management and shareholders by their own share interests, right? Then you sort of know that management is aligned with the shareholders. And, I think it's, you want to keep active, you want to keep relevant, but at the same time, maybe you don't want to do too much at one time and dilute yourself. So maybe those are opportunities where you can look to partner. A lot of companies with big land packages will enter into option agreements, and depending on the timing of the market and, different commodity prices, that may or may not make a lot of sense, right? The idea of divesting of an asset, are you leaving upside on the table? Potentially, but I think a lot of opportunities. If you are taking back equity, then you can continue to participate in that upside. Or sometimes you'll see more of a joint venture type arrangement where again you are sort of losing some of the upside, but you are maintaining an interest, right? So if it's a situation where you think this is not the value I want, well then let's kind of keep some economic interest, so we can continue to realize the value as it's created if you believe that it's still there. So it's a good point you bring up. There's a lot of ways to make these sort of decisions and to unlock the value, and there's a lot of different reasons to do it. Why would you sort of have something sitting on a shelf when you can be working with someone else to be unlocking value sort of in a more near term? Because at the end of the day, from an investor's perspective, they're going to look at their IRR, and maybe that leads to decisions of this has been worked on for X number of years. Maybe it's time to capitalize it and start to redeploy that capital to something that's a little bit earlier on the Lassonde curve, where you can generate these more outsized value creation opportunities.
I think you touched on something interesting there as well, that it's not so binary. There's a bunch of different structures where you can have those value creation opportunities still. Or give your shareholders exposure to those value creation opportunities in another entity or through some sort of structured agreement, not necessarily cash for projects, sort of one-for-one swap. So I think that's also important and can certainly be a good source of value creation for shareholders. Just as we're coming up on the hour here, I'm going to switch gears just a little bit and talk a bit about our macro backdrop here. The Fed's been raising benchmark rates at one of the most rapid paces in history. It's been a tough market for gold companies as rising real yields compete with gold as a safe haven asset. That being said, overall, the price of gold has actually held in fairly well, all things considered, given all those factors I just listed. The conversation now seems to be shifting to at what point and what magnitude the Fed starts to pivot, with discussions really centering around when in the coming months, not coming years. at that point, the gold space and junior gold space in particular could take off rather quickly. So, kind of two-part question here. How do you think about being positioned for that turnaround? And given that pending Fed pivot, where do you see the gold price being 1 year from now, and why? So maybe Brian, I'll start with you.
Sure. Yeah, I think it's an interesting thesis as we talk about the macro theme of gold price where it ends. So I might go about this a different way. I'll start with where gold price might go. I think there's both supply side, demand side fundamentals that will drive gold on a go forward in the next 12 to 24 months through all-time highs. And I think that that's very much a reality that we may see in the medium term. And how do we prepare ourselves? So, I always think about it as a CEO, and we're allocating capital, and we think about, well, where will we thinking and talking about in 6 months is really what we're doing now. So the holes we're drilling now will be seeing market in Q1, ensuring we have enough news flow to be relevant, ensuring we're allocating our strategy and our dollars appropriately to be newsy coming into 2023. I do think it's going to be a window, and that the window will open as the gold price moves strongly next year. I think technically there's a good bottom in. I think sentiment's been very low for the last sort of 6 to 12 months since last April. And it's encouraging to see the technicals kind of balance out, the base set in, has turned back up. And I think you're absolutely right that the junior space at our 0.17 PNAV multiple, which is what you had us at, is a great place that should see a value unlock as we move into 2023. So for us, it's getting our ducks in a row. It's drilling the holes, getting the programs in place now, having the capital in place and the permitting in place, and be executing such that we are prepared for a rising gold market, which I think we're already actually in. So that's how I say GFG would be handling it on the macro side and how it impacts our programs.
Great, thanks. David, maybe we'll come back to you. What's your gold price prediction, and what is White Gold doing to take advantage of where you see that being in 1 year?
Yeah, I think this is, from an investor's perspective, this is the time you want to be really positioning yourself, right? These great to have analysts like yourself that could quantitatively, highlight what these sort of multiples are today versus what they used to be, how they compare to the highs, how they compare to the norms. That is statistical data, right? So I think we're seeing that these are some pretty attractive times. There's these other sort of larger scale events that are, I think, looming on the horizon, which will continue to drive the value creation. My part of why I'm optimistic about the rising gold price here is the relation to the U.S. dollar. Obviously, with gold being priced in U.S. dollars, the U.S. dollar, because of the interest rate hikes, is incredibly strong right now. So as these hikes plateau, or indication of them starting to plateau, eventually go down, whenever that may be, if that even happens, I think that's going to sort of put a big drag on the U.S. dollar, which will probably contribute to the increase in the price of gold, right? And even just recently, I was at an economic forum with a notoriously bearish economist speaking, and he said, listen, these are cycles. This business is cyclical. At some point, the U.S. dollar is going to come off, and it's going to be the riskiest assets. The first things that sort of went down with the increase in the interest rates when the risk came off, those are going to be the first things to come back. And the U.S. dollar coming off is going to have a very significant impact on the gold price. And with our junior subsector being so significantly depressed because of that, that just shows a potential great opportunity for a very quick and significant re-rating. I think some made the point, the gold is actually held in quite well if you look at other currencies other than the U.S. dollar, right? So you're only going to be building on that. And when you're in jurisdictions like Canada or Australia, where you're spending in those dollars, are being paid in U.S. dollars with a higher gold price coming up, I think there's opportunities for very significant return. So I also agree. I think gold is going much higher. I think we go to all-time highs here, and I think it's next year sometime. And we look forward to that. And how do we position ourselves? Well, we're doing lots of great work. We're creating value. We're showing that we have a world-class asset, very economically robust, and ready to sort of move through the production cycle.
Great. Yeah.
Lots of
sense.
exploration going on in the meantime, right, to fill that pipeline like everyone else.
Perfect. And Patrick, over to you. How do you view the macro backdrop and gold price, where gold price will be in a year, and E79's position?
Yeah, I've been on the road the last 2 weeks, and I've been taking time. Usually I've been at the 1-to-1. I was at the Red Cloud. I was at the Precious Metals, and I always try to look at some of these technical presentations put on by economists. And actually, I saw Pierre Lassonde in the Precious Metals in Zurich. But we keep going through these unprecedented times, and specifically, the controversy with the U.S. Fed is, usually you hike up rates to curtail excess demand, but the inflation we're dealing with is nothing to do with demand; it's supply, and it's supply disruptions. And you've seen that those lockdown in China, you've seen supply chains really screwed up. You're seeing global climate change impact food prices, and then obviously the war in Ukraine's impacted oil prices. And yet the Fed feels that they have to get really, really aggressive with these rate hikes. And I think what's going to happen is, I think it's going to put us into a recession. I hate to say it. And I think, again, we're going to go into uncharted waters, and that's going to create a lot of volatility. And so when you see volatility and you see fear, then I think that gets people into gold. The other thing I've noted is, and I hate to say this, but I'm taking a little bit of glee into it, is the imminent collapse of the cryptos, which I've always thought were garbage. And people saying that those are form of currency. And yet here we are, gold is the hero. Gold's holding together nicely. And so, as we get into more uncertainty, as we get into more turbulence going forward, gold's going to do its job. And, even if, the Fed, stops these rate hikes, it's still going to put us into a tough spot. And, again, all these governments are up to their eyeballs in debt. So they're hurting, they're screwing themselves these high rates as well. And that's going to cause a lot of turbulence. So, you know what, gold's doing its job, and it's going to keep doing its job. And I think we're going into actually, a new era of gold. And I'm not saying we're going to have $5,000 gold, but certainly I don't see any downside whatsoever. I just see upside. So yeah, I'm pretty optimistic on gold, just based on global economic and financial situations.
I realize I'm preaching to the choir here, but I would have to tend to agree that we're reaching pretty close to peak rate expectations, if not peak rates, which tend to drive the market, and could see as real yields start to roll over gold, which can really be thought of as a currency coming back in U.S. dollars terms with quite the vengeance. I do see a good setup here for new all-time highs, or to at least meet new all-time highs in the next 12 months, and I think that'll bring a lot of eyes to the gold space and the junior gold space in particular. So, with that, that just about wraps it up for today. I want to thank each of our panelists for joining me today and for the excellent discussion over the past hour. As a reminder, a replay of this panel will be available on the SIX website in short order. Also want to thank everyone who tuned in today to watch our discussion, and have a great day, everyone.
Thanks, everyone.
Thank you.
Appreciate it.